Well, Matt, let's hop in. Where do you want to go first? You want to talk about the Fed? Or you want to go into this?
Fed. I know you noted. I was like, yes, let's talk about it. So the Fed had, and you kind of put me onto this. The Fed has recently released a policy statement, an update actually, a policy statement on prudent commercial real estate loan accommodations and workouts.
And is this in the response to the report we put out recently, Matt, or just
your spin on it?
That was my spin on it, but maybe that's just a coincidence. As far as as much as you want to believe in coincidence.
Yeah, just to summarize the reaction, that was Spencer's like, oh yeah, well obviously the
Federal Reserve reacts to Great Capital's recent report, which you can find at the Great Capital LLC.
That's true. We'll have to track see who downloaded it if we get a .gov.
Yeah, interesting. It has blown up though, so I'd check it out. I mean, a lot of people downloaded it last week. Anyway, Matt, so what are they figuring out? What is changing? So, and what are they foreseeing? Because this looks like it's like they're preparing to have the right tools in the toolbox.
Yeah, I think so, and then that's probably the best takeaway. Now, I will preface this by saying my takeaway was, oh, great, a statement on loan accommodations and workouts. Does that mean they're going to bail out? I mean, they're going to accommodate. They're going to make it easier for people that could have distressed property. Now, I said that's kind of annoying for everyone that's waiting for distressed properties to kind of activate the market and create a little bit more of a deal flow. But I don't think that there is much teeth to this. But it does kind of outline. I think this what your point is the best one here. Is it shows what they're thinking about, and they see it coming along, and it's not just multifamily.
And so just on the background, just the background of what we're talking about. So back in 2009, the agencies, so, that's the Fannie Mae, there's different types of, government or quasi-governmental organizations, along with federal financial institutions, and some other organizations. They basically created a framework for how lenders can work out bad loans with borrowers.
Okay.
And so they put together basically a set of not rules but again guidelines of here's how we'd like to use if you're in this situation, here's how you can work out the problem so we can avoid economic calamity. To basically in a sense informally formalize, the kind of extend and pretend avenue that we've been talking about, which is basically where, hey, we know right now you're underwater, upside down, things don't, but you're a good borrower. We don't want to take back the asset. As a bank, as a lender, I'm not in the asset management business. I don't know what to do. I don't have the team to have the conversation with the property manager every week and to replace the toilet. They're not tooled like that. So what are we going to do in different circumstances to accommodate if they can't accommodate?
Yeah, so it's better to give you a little bit more lenient terms, be a little less strict because you're in trouble. And that way they don't have to, take it all back. And actually it's less expensive for them to be lenient in kind of these situations is the way that I kind of was understanding.
Because especially if it's a case where it's, it's a good operator, it's a good borrower, it's just, it's product of the circumstance. And in the environment right now, and this is, I think, a very strong argument that could and is being made. Look, interest rates are high right now. We've had a bad year.
Yeah.
Interest rates most likely, according to the Federal Reserve, everyone else, will be lower in a year or in a couple of years at some point.
Yeah.
Give us a little bit more time. Instead of the 12, 24 months, just give us the 36 or the 48. Just a little bit more time. And maybe if we don't have the money to pay just let's work on a payment plan that you agree to. We owe you $1 million a year. We're going to pay you $400,000 a year, and we'll make it back up. And it's there's some. It's not going to be free. They're going to have to be modifying the covenants of the loan docs. But just some framework that is going to give the permission to these institutions when they find themselves in these situations, just what to do and what's okay. And also I think what the Federal Reserve, from their position as like a banking system regulator, would like to see happen.
Okay. Yeah, I did highlight this passage so as kind of a difference between or an addition to the 2009 statement. And it says that consistent with safety and soundness standards, the final statement reaffirms two key principles. The first is that financial institutions that implement this loan accommodation after performing a review will not be subject to criticism for engaging in these efforts.
You shall not speak poorly
Yeah, exactly.
of these institutions.
Well, it does seem like, there is an unstated expectation, like, okay, we're not going to come down on you, maybe. But again, no real result of what might happen. Number two is that modified loans to borrowers who have the ability to repay their debts according to reasonable terms will not be subject to adverse classification solely because the value of underlying collateral has declined to an amount that is less than the outstanding loan balance.
So basically saying if you're underwater, the value's gone down, well, yeah, you're good.
I guess, well, I can see, that's the thing. That was why I was annoyed. It was like, the market could take care of it. Now, maybe the office market, if it's crazy crisis mode, that's another thing entirely. But for multifamily, there is like, it's hard to see people going and crashing and diving, crashing and burning and getting rescued.
You feel like sometimes the entire economy is like we're playing like bowling with the bumpers on. Sometimes like like no, we can't have, no one can get hurt.
We're waiting for gutter. We need the gutter balls.
Yeah, right. Otherwise, you think you're great, and so you keep throwing it the same way. You don't have to improve your I'm not a bowler. Your toss, your throw.
And what I think, and this is it's a little bit of a poor analogy, but it is something that we have discussed in that, like, if these operators, and let's just use retail for an example. Let's say it's an operator who is not getting a lot of profit, but he's waiting. He's leave that storefront open because he's going to get that higher wage, even though his building's not great. He's not, but guess what? He just got to work out on the loan. And so he doesn't have to fill it. He gets to continue to wait and continue to not use it as efficiently as he could. And you're still going to see that empty storefront.
It excuses and potentially encourages poor and malinvestment.
Yeah. So that's
in the scale of hundreds of millions and billions of dollars.
Yeah. Now it will save people. People will be happier to have their loans worked out. And like just in the same way that distress is going to be a tragedy for some people, but we got a plan for it, and we didn't need the federal government stepping in to address.
Well, there's a lot of just bad owners out. I mean, there's a lot of great owners, but there's a lot of bad owners. There's a lot of people who made decisions and took risks that they probably shouldn't have, and there should be losers, and there should be opportunities for new participants to come in and create opportunities and build wealth. But there'll be fewer of those opportunities because those that already have the capital, who have misallocated the capital, and because capitalism, which we don't have, there's not real free market capitalism, but it's a system of like resource allocation, and the market, it works off signals, and prices are signals. There's different signals, but if the resource is, if we're rewarding major capital allocators for poor investment decisions and poor allocation, the system doesn't get any better.
Yeah.
It just can't work. Now we're solving to make everything comfortable and less volatility, to have less short-term pain, but does it create longer-term systemic issues? And then again, people are complaining that you have bad landlords and people not taking care of their properties, and it's like, well, these people getting you sort of called it a bailout, and it sort of is a backdoor bailout in a way. It's you're not necessarily handing people money, but you are in a sense that the money that they are supposed to hand over, you're letting them keep.
Yeah.
So
saving them some.
And now we're not going to get into student loans, but I the same arguments that I would make against forgiving. Now these loans aren't being forgiven; they're just you're modifying the terms. But maybe they should have tried that for student loans. I don't know, but I'm just saying the arguments of you're picking one group of people, one group of Americans, and prioritizing them, forgiving those loans. But it's like, but what about the guys that go into trade school? What about the people that didn't go to college and they tried hard, they started a business? Where's their check? Well, same thing with the same argument can be made here. Well, what for the people you're going to modify, loans for borrowers? Well, what about the office? What about the borrower of another business or something that doesn't qualify?
Yeah.
Or the person that couldn't buy it because they couldn't. There's a whole lot of groups out there that love to have their loans modified.
Yeah.
So we're picking and choosing.
Yeah. You could translate. You could ChatGPT change the language. Instead of CRE borrowers, we're talking about student borrowers.
Yeah. Interesting. Would be interesting.
Yep.
So, man, I know it's 90 pages. That's why people come to the Gray Report. Any other takeaways?
The other thing that it did add was some examples on like page 75 or so of the report or publication. It has some multifamily examples. So here's a loan. This is how I summarized it to Spencer earlier. It says like, here's a loan. So and so is not making money on it, and it has devaluation of a property, and you give him a break this way. Here's another loan that's a bigger problem. Oh, you give him an even bigger break. There's no.
Yeah, this is great. Let's go. Okay, so which example? Which example is it?
Yeah, page 75. It starts.
Okay,
with,
sorry. They've got a lot of examples, a lot of scenarios.
There's like it'll take one property, like a multifamily property, and it'll run it through, and a hotel one, or retail, or office. And I think they also have a single family one as well. But basically, yeah, there's no solution that says, oh yeah, you kick him to the curb. This is a kinder. These are kinder scenarios.
Yeah, I mean, my kids' baseball games, there's no outs.
Yeah, that's right.
And you think they're like, okay, well, when they're like 8 or 9, they'll start playing for real. But like, no, according to this guy, didn't see, there's no outs. There's, when we're
yeah. We'll give him a break. So
multifamily property, base case, take it, Matt.
Lender originated $6.4 million loan for a 25-unit apartment building. At maturity, the lender renewed the $5.9 million loan balance. Leases are typically 12-month terms with additional. So these are kind of typical stuff. 88% leased, but due to poor economic conditions, delinquencies have risen from 2 units to 8 units. 6 of the 8 units are 90 days past due, and these tenants are facing eviction. So this is the scenario. At maturity, the lender renewed the loan balance on principal and interest payments for 12 months at a market interest that provides for the incremental risk. Borrower had not been delinquent. Current financial meant the debt service coverage ratio is below 1. That means it's underwater, right?
Yeah.
So it's 80 or 0.80x because of the rent payment delinquency. Borrower projections show a return to. I'm sorry, I'm kind of skipping ahead here. A new appraisal has not been ordered. However, the lender noted in the file that if the borrower does not meet current projections within 6 months of booking the renewed loan, the lender will obtain a new appraisal. And I want you to tackle the classification.
So the lender internally graded the renewed loan as pass and is monitoring the credit. The examiner just agreed with the lender's analysis and classified the loan as substandard. So basically the lender is saying, we're not going to get an appraisal. It's all good. While the borrower and guarantor can cover the debt service shortfall in the near term using additional guarantor liquidity, basically saying that the guarantor is just going to come up with cash out of his own pocket.
Okay.
The duration of the support may be less than the lender anticipates if the leasing fails materialize as projected, saying, all right, you got some cash in the bank now. You can keep floating the loan, but you don't get these units leased up, you're going to be in a bad spot. You're not going to be able to do it.
That seems reasonable.
And they may say, and I don't know if they said that they had to do this, basically, you're going to have to add those like reserves. You've got the cash, you're going to have to add in, drop it into escrow, which they did during COVID. They had, they had big COVID, debt service escrows for most loans, and it made capitalizing a little bit more difficult. Economic conditions are poor and the rent reduction may not be enough to improve the property's performance. Lastly, the lender failed to obtain an updated collateral valuation, which represents an administrative weakness. It's non-accrual treatment. The lender maintained the loan is in accrual status. The borrower has, it means it's accruing.
A little bit more strict.
The borrower has demonstrated the ability to make regularly scheduled payments, and even with the decline in the borrower's credit worthiness, the borrower and guarantor appear to have sufficient cash resources to make these payments if projections are met and full repayment of principal and interest is expected. The examiner concurred with the lender's accrual treatment. So basically saying, come up with the cash.
Yeah. So there are other ones where they accept the debt on it's non-accrual. And basically, if the harder situation you're in, the more generous the potential workout is going to be.
Yeah, it is. It is interesting. The worse you get, the more help you get. Which sort of makes sense.
It is nice.
Yeah. So there's a framework for assisting borrowers, borrowers out. Now a lot of this, I assume, is going to be really directed towards agencies. Within the FHA, Fannie, Freddie, and HUD. But probably not going to be as applicable. Although I'm sure that they'll use it as a guide to the bridge lenders and the debt fund folks, which a lot of the kind of the distress and the concern. Is concentrated from those debt providers rather than the agencies. We always know the agencies are really there to act as a stabilizing force in the housing market, kind of sort of be a lender of last resort, and kind of the door is always open.
Yeah,
there to accommodate. Really not there to. They're not really there to be a maximize profit at all costs.
Okay.
They really shouldn't be by their charter. But bridge lenders and debt funds are a completely different animal, and so it's going to be what they can handle, what they can do, and what they want to do, how they can make the most money.
Okay.
So it's gonna be interesting.
Yeah.
But I think that, I think if you've got an agency loan, you're probably going to be government sponsored entity guarantee. There's going to be some more stability for you and more options than if you'd gone with a private bridge lender or debt fund lender. Not that there aren't reasons to go that route in the right circumstance, but again, it's just during 2021, that was so many folks were closing with these bridge lenders and short-term debt, hoping to refinance later this year.
The parachute is for a little stronger if you had the agency, but some of the most endangered people don't have that parachute.
No, if you were, pedal to the metal, full on risk, you weren't going agency. People, weren't just ever, but typically not.